Today are George Glynis, he's the head of analytics at ETM Analytics, and Elise Kruger, she's an economist at NKC African Economics, and both of them were actually betting that we might get a rate cut and are presumably disappointed. George, let me start with you. What are your thoughts on the decision, and do you think they missed an opportunity?
I think they probably did. My frustration with this bank, and it's been for some time now, is that I believe there's something not quite right with either the manner in which they're analysing their risks and the manner in which, in fact, they've been analysing inflation, because throughout the course of 2017, they've been revising down their expectations for inflation quarter after quarter after quarter. So that's a first issue that I have. The second is that I'm not sure that they are analysing. I don't believe that they're on top of the RAND calls. So I believe that there's a deficiency on that front because they certainly haven't anticipated some of the movements that have happened through the course of the past year. And then the third thing is there seems to be an inherent conservatism since Governor Kganyago has come in. Now, not that I have a problem with that in and of itself, but it seems like we almost looking for the problems whenever we sit down and decide on interest rates. And again, it goes back to the point that I was making a little bit earlier. I'm not sure that they are assessing the risks appropriately. It's almost like the risks are being catastrophized a little bit too much. And sometimes those risks are perhaps overblown and overplayed, and perhaps deeper analysis of those risks is required. I mean, one of them, and has been around for quite some time, has been the ratings downgrades and the impact that these ratings downgrades would have. And we've had several through the course of 2017, and yet the rand strengthened. The same thing happened in 2016. Now we're going into 2018, and we're using the expulsion from the WIGB as the potential catalyst for big outflows. But there are many mitigating reasons why that need not be the case. And so again, I would question the assessment of those risks, and I would strongly urge the central bank to perhaps rethink the process which they're adopting to assess those risks, because I don't believe that they're as great as they're making out.
You're getting ahead of my thought process. We'll come back to the ratings downgrades in just a moment. But Elise, just your very brief impressions of the decision.
Yes, I'm also a bit disappointed. I think they missed the opportunity. If you look at the headline CPI downgrade in forecast from 5.2 to 4.9, that's quite a big downward revision to headline CPI number. With figures, early in the year turning around 4.4%. If you're not cutting rates, if inflation is so benign and the rand has strengthened by 13% against the dollar, then it is in a way very conservative, especially if you also look at the real interest rate. And that's another angle, I think, which they haven't touched on. By not cutting rates today, our real interest rate will, in this first quarter of 2018, be in the order of 2.3%. That is the highest since 2010. With an economy, growing on average only about 0.6% in the past 2 years, it's definitely an economy now in dire need for stimulation. And still, our real interest rate is the highest in 7 years, and the Reserve Bank sticky to adjust. So, from that point of view, I think they had an opportunity, to just help the confidence on a bit on and help spending a bit on. I mean, 25 basis points, and with a 13% appreciation in the rand exchange rate, there's quite a bit of fat. Even if we do see a bit of rand weakness for some reason, there's quite a bit of fat built in after this recent appreciation.
I agree with you for personal reasons. Without looking at the bigger picture, it would have been nice to have an interest rate cut. But what about the risks that he highlighted? He talked about the ratings downgrade, which you've alluded to, and obviously, things changing politically, the uncertainty about what's going to happen in the near term. Now, if things do turn negative, and they had cut interest rates today, it means that they would have to really hurtle up rates going forward if they were to take that chance today. Your thoughts?
Well, I'm not so sure that that's necessarily true. So let's just start with the political situation. If you had to look at the balance of risks as things stand right now and the events that have unfolded through the course of January, I'd say that the risks are asymmetrically skewed more in favor of positive outcomes through the course of the next 6 months than negative ones. You know, the worst case scenario is that Zuma stays in power for a little bit longer. But I've yet to read an article that suggests with great conviction he's going to last his full term. So the risks on the political front have certainly abated, and abated considerably. Again, on the fiscal front, there was a significant reset that happened in the MTBPS, where realities and expectations, both by the market, economists, business people, everybody, was reset to a much lower level than was the case previously. So we had a great deal of realism that came through in the MTBPS. And in fact, when you look at things like he mentioned the cyclical upswing that's unfolding, the synchronized cyclical upswing, you may even find that the budget, when it gets announced later on in Feb, results in a little bit of relief rather than anything else. I think what I found interesting was that the biggest risk for me, if there was a risk, would probably be Eskom, and there was very little mentioned about Eskom other than the NERSA decision. I'm talking about, you know, Eskom's finances being as poor as they are. So it was a peculiar statement, and for me, interesting, but I don't necessarily have a problem with the unchanged, but in the context of what Elise was saying, a very weak growth environment, they probably might look back on this and think that they missed an opportunity to just trim.
Elise, the budget is around the corner, as George is saying, but of course there's this, estimated 12 to 15 billion rand hole that needs to be funded for the education policy that kicked in at the beginning of the year. Where is Malusi Gigaba going to find that money? And on top of that, we have a broader 40 billion rand hole in the public finances. And that is a key risk, and obviously the ratings agencies will be looking at that.
No, indeed. I think the way in which the budget will be approached is important, but also maybe in that regard, the higher economic growth expectation, which was also on the table today, slightly up for 2017 and also for 2018, will also help to spur, your tax revenue increase, growth and so on. So I think the slightly bigger growth will also help the fiscal problem. But yes, indeed, what they will actually come up with in the budget will be very important, from a ratings point of view and for the general perception of what the impact will be on the economy.
All right, well, we're going to...
If I can also just jump in there and just say that, if anything, when we look at the budget and what needs to be funded, there's serious question marks whether this is going to be something more along the lines of a growth restrictive budget that they put through. How they fund it is going to have to be a combination of some curtailment on the expenditure side and potentially a rise in the debt burden, in the tax burden on the private sector. The combination of that detracts from GDP growth. It's typically the kind of signal that central banks have in the past utilized to loosen the reins, not keep them tight.
George, we're going to pick up on your thought just after a short break. Let's go for that short break and we'll have more on this.